Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone, welcome back to another episode of On the Margin. Today, I am joined by the CEO and founder of Blockstream, Mr. Adam Back. Adam, welcome to the show.
Yeah, thanks for having me on.
Yeah, I appreciate it. We're talking at a very interesting time, I would say. There's obviously a lot that's going on in the world from a geopolitical standpoint, from a macroeconomic standpoint. And of course, Bitcoin is starting to heat back up a little bit after 18 months or so of sort of bear market winter. And where I'd love to start in this conversation actually is, I know you spend a lot of your time on Blockstream and Bitcoin, but I know you're also a very worldly guy as well who has sort of views about the macro. So maybe just starting from your 10,000 foot vantage point, what are some of the things that you're paying attention to in the macro environment? And then maybe we can transition that into your view on Bitcoin.
There's this quote in the Bitcoin Genesis blog, right? The British Chancellor on the brink of a second bailout for banks.
Yep.
I used to trade stocks a bit, and generally try to keep in mind the idea that you were trying to achieve a real return, which means a return above the actual rate of inflation, and you never quite know what the real inflation rate is. Governments tend to manipulate it and so on. And so it's kind of interesting, it's 15 years, I just saw that, talked about on the social media since the Bitcoin paper was published, and that the 2008 was the financial crash that people who were looking at the market at that time kind of just lived through when Bitcoin first appeared on the market. And here we are again. It's a kind of similar situation in a lot of ways. The world is in a fair degree of financial disarray, and even the thing that kind of kicked it off this time was COVID and a probable massive overreaction to that, large amount of money printing, supply chain disruption, now some geopolitical strife going on. So the last 2 years were kind of just kept giving in terms of all of the sort of negative news flow, I guess, for financial markets. And of course, the interesting thing now is that Bitcoin is getting sort of gradually over time more acceptance and understanding from the conventional finance world. And so they're talking about Bitcoin on financial news shows. Their top management and sort of like economics analysts are commenting more favorably. And I think it takes sort of traditional world people quite a while to take some new technology seriously. So that's finally starting to happen, I think, particularly with the current round of major US financial institutions trying to get a spot ETF passed, and many of them offering Bitcoin related financial products to their clients due to demand, basically. So interesting timing for what's happening with bonds. With the interest rates rising, I saw in the news that I think it was UK pension funds, which sort of manage long-term capital for people's retirement plans, were down 50% because they were hugely exposed to long-term government bonds, and the interest rates went up, faster than anybody ever expected them to. And that has an implication. So, anybody who was expecting to retire based on that now has a problem.
Yeah, very well said. Of course, this week did mark the 15th anniversary of the publishing of the Bitcoin white paper. Some folks pointed this out, but there was on the same day, the actual day of the anniversary, that was the day that the Bank of Japan actually abandoned their 1% yield curve control hard cap, which was just a funny little, you mentioned sort of this historical idea of the inscription on the Genesis block for Bitcoin. And, we keep kind of getting these little things that even in today's day and age, the entities, the institutions are different, the countries are different, but this idea of money printing is still the same. And in fact, if there's anything, maybe perhaps the most significant difference is just the sheer raw amount, where it actually hasn't gotten better. It seems to be almost exponentially compounding and getting much and much worse.
Well, the US national debt clock's going to need another digit soon, right? It's going to roll over or something.
Yeah, slap another zero on there. But I think you point out a really interesting connection between Bitcoin and bonds specifically. So long dated debt, but even the treasuries, which has been historically one of the safest places to park your capital. TLT, which is an ETF that trades here in the US that is long bonds. So I think it's just 20 and 30 year, maybe 10 year in there as well. I saw a statistic the other day that it was actually down more peak to trough than the stock market was during the great financial crisis. So the wipeout in government bonds, which are supposed to be, extremely the safest place to park your money, has been truly a sight to behold. I guess my question to you, Adam, is do you see a situation where global investors start to lose some confidence eventually in the bond market, especially if governments keep relying on this extreme supply of bonds to finance their fiscal deficits and maybe find their way into Bitcoin? Or what is the relationship do you see there between bonds and Bitcoin?
Well, yeah. I mean, I think some of the traditional conservative, like long-term fund management strategies, like the 60-40 portfolio with 40% bonds, are struggling, right? That was the safer component of it, and it turned out to be the worst component of it, at least for the moment. So I think, it's a potential opening for them to rethink that kind of rule of thumb strategy and add some Bitcoin allocation as a kind of long-term store of value, right? So with a growth story. So I mean, gold, of course, has kind of sometimes a small allocation in portfolios, but it's just primarily as a hedge, but doesn't really tend to grow. Whereas Bitcoin is still early in the adoption phase. So I think there's more adoption upside ahead of us, unlike gold.
So one thing I wanted to get your thoughts on is, I think one thing that might be slightly different this time as the price of Bitcoin starts to pick up, you start to see the beginnings of excitement again for the first time in a while. Obviously, a good portion of that is being driven by the ETF, a spot ETF here in the United States, and specifically the iShares for the BlackRock ETF. I think in terms of date, we're waiting. The next time the SEC is due a response is January, and then the last one is March 15th, I believe, is the last date. What are your thoughts in general about the likes of a BlackRock ETF or Larry Fink going on CNBC and calling digital crypto a flight to quality asset? I mean, is that something that excites you and sort of says, "Hey, I've been in this from the beginning, and this feels like we're making it here"? Or are is your soul crushed a little bit because these are the institutions that we're supposed to be disrupting? What is your general thought when you see that sort of thing?
Well, I mean, it has two sides to it, all right. So, I think people are always a bit concerned about self-custody and storing your own keys, running your own full nodes, learning how to do that, because it gives you the Burris resistant quality. And of course, some people are obviously holding their Bitcoin holdings on an exchange or in a custodian, like for an ETF in other places in the world. And an ETF won't have that property clearly, so if you are somehow involved in some political activism or somehow have a situation where the government takes a dislike to you, and in Canada, that turned out to be as much as donating to, Canadian truckers who were protesting, then they just preemptively froze people's bank accounts. And I think people were pretty shocked to see that in a major kind of democratic country. So I think, that's something to bear in mind, that a share portfolio or a bank account or a Bitcoin ETF has that kind of risk associated with it. But at the same time, it's clearly hard for the average person, perhaps a bit older, less technically sophisticated, or just the IT backup risk of backing up coin private keys and things like that. So it does make it accessible to more people, and there are some sort of structural reasons why something like a mutual fund probably can't buy physical Bitcoin, just due to regulations and laws. They're not allowed to, even if they want to get an exposure. So their only current way would be, probably one of these futures-based ETFs, which are quite inefficient. They have a lot of drag and slippage, so they lose some of the money to the inefficiency. So I think from that perspective, it helps people get access. And I think the other way to look at it is, the fundamental value of Bitcoin is the permissionless, bearer censorship resistant money, and so you don't want too much of it to end up in these sort of custody-based systems of ownership. But we should expect that investors who are not directly using Bitcoin for its properties are going to want to invest for the same reason that perhaps in the early internet, there were people who didn't really get it. They could see that the internet was maybe exciting to some people, but they hadn't got it. But because it had a good growth curve, they would invest in some internet stocks, right? And so, I think there's some of that going on, which, it is what it is. So, yeah, I think it's sort of some advantages and some risks.
All right, everyone, we will be back to the program in just a moment. But before we do, I wanted to give you the inside scoop about something that we've been cooking up at Blockworks these last couple of months. So in March of this coming year, in London, Blockworks is going to be gathering 1,200 of the world's largest asset managers. So that's fund managers and allocators, financial institutions, think big banks, payment providers, etc., and professional traders at the largest institutionally focused conference in digital assets, DAS London. Now, it's very rare that you get the likes of JP Morgan, Goldman Sachs, Point72, the large HFTs, the family offices all in one room at the same time. So if you want to know what the big money is doing in digital assets these days, this is the conference for you. To give you an early sneak peek at some of the stuff that we're going to be talking about, one, the intersection of macro and digital assets, and where are we in the market cycle. We're going to be talking about real world assets, so that's stable coins, on-chain treasuries, all of that fun stuff. And we're going to be talking about things from the allocator perspective. So what are the big money managers in crypto doing these days? And because you are such a good listener of On the Margin, I'm giving you an extra code, MARGIN20. So click the link at the bottom of this episode. Again, use code MARGIN20, and I will see you in sunny London town in March. But one thing, you've obviously seen quite a few cycles here. And for those of you who don't know, your invention of Hashcash back in 1997 was actually cited in the original Bitcoin white paper by Satoshi. So you've obviously been around for quite a while in Bitcoin. And for those who are maybe a little bit newer to the space and they're sort of looking at this from the perspective of this could be their first cycle, I would love to get your thoughts, because it is always funny to watch how narratives sort of change and coalesce and get formed around these sort of inflection points in markets. And one of the things that was, you were hearing 12 or so months ago was something like, we're never going to see a money printer like that again. This is probably the last cycle for something like Bitcoin, and it's not going to come back. And now you're starting to see a shift where the BlackRocks of the world, these big institutions, are kind of actually for the first time looking to really embrace Bitcoin in a serious way. And I guess what I'm sort of asking you here is, A, do you see us being on the precipice of a new bull market? And if so, does that markedly change from past bull markets based on institutional participation?
As more money flows into Bitcoin and the price is higher, it takes a larger scale of ongoing investment to push the price further. But contrary to people's kind of intuition, it doesn't, if there are, a certain number of new coins being produced every day, it doesn't mean that the price of those coins is literally the amount of money that has to flow in to cause the price to go up, because it's all based on the margin, right? So the price is the equilibrium in the market, and a lot of coins are cold stored. So $1 million in is probably going to push the like say a bigger number, like $1 billion of new capital coming in, is probably going to do a lot more to the market cap than add $1 billion to it, right? So I think that the current market is a bit unusual, like it was held back by the last couple of years of events. So all the macro stuff we talked about, the COVID, supply chain, geopolitical issues going on, and all the money printing, and then some in-sector drama, the DeFi failures, the FTX, which is resolved now. So perhaps that's a chapter that can put behind us, that, the SBF has been found guilty. And so I think that based on previous cycles, metrics, I would have expected the Bitcoin price to be, maybe $100,000 last year already. But all those headwinds perceptually set it back. And I think that, the market doesn't understand the new technology like Bitcoin very well at times. And so, an asset that should actually be viewed as a hedge against some of those risks was actually hurt by the risks because people are misperceiving it, right? So anyway, so as those sort of risks are sort of taken on board and adapted for, and we have a bit of positive news cycle for some months, I think there's a prospect to get back to where we would otherwise have been, potentially even before the halving next April. And then, of course, the typical wisdom is that you get a price appreciation after the halving, maybe 9 months to 18 months afterwards. And that's what's happened statistically in the past. But I think potentially both could happen. But, Bitcoin is volatile and does its own thing. So we'll see what actually happens. But certainly there's a reasonable expectation to my mind that, an ETF will get, a spot ETF will get approved. Well, probably multiple of them, right? Because they're all seem to be equally valid applications and from credible providers. And that in itself could, move the needle. That's probably going to happen before the halving.
So I just want to underscore that for listeners. And I was listening to another recent interview of yours, Adam, where you talked about the potential of, new all-time high, even maybe $100,000 Bitcoin by the halving. So I guess is the belief there that if I had to summarize your viewpoint, but not that I'm going to hold you to any sort of price target or anything like that, but if I had to summarize your viewpoint, is that, look, basically what happened at the end of November of last year with FTX was something that was endogenous and unique to digital assets. Bitcoin got hurt more than it otherwise normally should have based on regular sort of cycle or cyclical dynamics. And you'd expect some sort of reversion to the mean where we actually recovered to where Bitcoin should be, maybe from a more intrinsic value standpoint, a network effect standpoint, a currency, more broader global currency debasement standpoint, and that would actually pull up the time frame of the price appreciation of Bitcoin relative to the halving, which has been a big cyclical catalyst for Bitcoin historically.
Yeah. So I think it could, we could get a first stage recovery. I mean, of course, Bitcoin is already up over 100% this year, right? It's
right.
Closed December 2022 at around 15,500, and now we're around 34, 35. So it's already more than 2 times up. But I think there's a prospect to get to a new all-time high or 100,000 before the April halving, and then, wait for the halving cycle to do its thing and see some further appreciation from there into later 2024 or 2025. And I mean, there were a number of metrics that are unusual about the last couple of years, apart from the factors that caused it, but just the the financial metrics people construct. So one is the 200-week moving average, exponential moving average, which historically the price had never fallen below that, and it dipped below it, a couple of times during the COVID period, right? Which I think to me showed that, these external factors had impacted Bitcoin, maybe unreasonably in a way that didn't make sense ultimately once it's shaken out in the market.
I think one of the other things that I wanted to ask you about, outside of just directly owning something like Bitcoin, either spot Bitcoin or through, God willing, an ETF at some point, is I wanted to get your thoughts on the mining space, and that'll transition into sort of this renaissance in Bitcoin block space that's happening. But you at Blockstream actually just released a very interesting new product, Basic, so Blockstream ASIC, and I wanted to give a sense of listeners for what that product is and why you're investing in it.
Yeah, so actually it arose organically, which is Blockstream is in the hosting business. So we provide sort of co-location for people who want to buy and put online thousands of miners, so larger customers. And what we found is that because some of them were like, a fund or something, they were new to Bitcoin, and they'd make an economic decision like, okay, we want to do some mining, which is cool. They're getting into a new sector, but then they would expect that, they could wire us money and get the miners on in a month or something. And we're like, no, it doesn't work that way. They don't, the manufacturers don't have inventory because they don't have the capital to, have billions of dollars of equipment sitting in a warehouse ready to ship, like a company like Dell or Apple might, right? They've got a supply chain, they've got a lot of capital, they can have equipment ready to go. And the fact of the matter is that the ASICs that go into the Bitcoin miners have, a 5-month manufacturing process minimum, right? So you send money to the foundry, they make you some more wafers, you won't get them back for like 5 months, and then you've got to assemble it into a machine. So the minimum time between paying money and getting a miner in a kind of quiet period in the market would be 6 months. And then when it gets busy, people start pre-ordering, and then you might be looking at 9 months, 12 months. And if you make a big order, they might say, well, you'll get your first machine in 9 months, but they'll come in 12 batches for the 12 months following that. And so we ended up buying, some inventory to be able to have a supply to sell to people. So then if they came and they made a decision, we'd say, well, we don't have inventory, but we've got some more, a next batch coming in 2 months' time, so we can start to get you online over, the next 3 months or something. And because of that, we ended up at the time buying them around $25 terahash. It's a quiet time in the market. I think the build cost probably around $20 a terahash, and we ended up selling some for 60, and the price when the price went up to 65 and then 69,000, the Bitcoin price, the price per terahash surged all the way up to 120 or even $130 a terahash. And so that was a sort of, we didn't buy them to speculate. We bought them to solve a supply problem for our customers. But afterwards, we got to thinking, well, that's interesting. The swing, the surge pricing in miners was actually a bigger move than the price of Bitcoin at the time. So if you look at it around that cycle, you could have actually bought them at the bottom using Bitcoin itself and sold them at the top and made a 2 times return in Bitcoin. Now, of course, that's, hindsight, right? But clearly there existed an opportunity there. And so we thought, well, let's put that into a fund strategy. And there's potentially an even better setup at the moment, which is that because of those big pre-orders in 2021, 2022, people continued to receive miners up to 2023, and they actually didn't plan far enough ahead to secure hosting to put them online. They just bought the machines. There's a long lead time, and what's happened is that there's a lot of inventory, which they call it new on pallet. So they're still in their boxes. They're shrink wrapped, never opened, sitting on shipping pallets in warehouses. And there are, we don't know how much, but I think quite a lot is the evidence of miners like that. And there's a secondary market where you can buy these miners. They're brand new miners for $10 to $15 terahash. So even below the manufacturing costs, so the manufacturers wouldn't want to sell at those prices. And the people who have them are, people who intended to mine with them. Some of the manufacturers have excess inventory, and some people lent to miners and ended up repossessing them because they were the collateral. And so that's one factor. So until that inventory is used up, the miners are artificially cheap, like below cost. So that's, when we did this before, we were paying, manufacturer prices, right, with a margin. Now they're below cost. And then the other interesting thing about the setup now is that the price is up over 2 times year to date, and yet the Bitcoin price, and yet the price of miners is actually down like gradually throughout the year to this 10 to 15. I think we start at the beginning of the year, more like 15 to 20. So, that presents more upside. The higher Bitcoin price, if you're buying with Bitcoin, your purchasing power is improved, and the cost of the goods, the miners, is down. So we create this fund. The first series is closed. So we'll be putting that money to work, and then we'll launch a couple more series. The first one is European-based and international. So Luxembourg securitization is the top level. That's available to Europeans and international buyers. And then we have a US structure coming, which will open up to the US market, accredited investors, and another series for the international as well. And of course, these series will be slightly different economically because the Bitcoin price going in will be different, and the average price we're able to buy miners for will probably be different. And it's a one-off strategy fund. So we basically buy the miners, store them in a bonded warehouse. We don't power them up because there's a premium for new miners. Used miners are very hard to sell. They command a much worse price. So people have a trust issue with knowing, how worn they are, whether they were treated well. You're taking a real chance buying used miners, basically, especially when the new ones are relatively cheap, right? And then, as the inventory gets used up, there's an interesting effect, which is once all this excess inventory gets online, as people, and you can see the hash rate going up, so it is gradually going online. At some point, there'll be no inventory left, and it will switch to needing to pre-order from manufacturers again, right? Manufacturers are not putting money to build inventory right now. They're probably many of them have still got excess inventory. So as soon as they receive orders, there's an automatic 6-month wait. And so at that time, we can say, well, you could pay the manufacturer 25, you could pay and wait 6 months, or you could pay us 35 and take immediate delivery or something like that, right? And that is something we've seen in the past. There was a time where it made economic sense to pay as much as $10 a terahash per month. You would get the miner early because that was the value of the Bitcoins you've mined. That formula's changed a bit because the price is different and the hash rate's different, but you can see there's a time value. And then I think the other point is, as we get into the next cycle, you could get a surge pricing situation again. So ultimately we'll sell the miners and then wind the series down, pay out the funds. The other unusual aspect of this fund is that it's on a Bitcoin basis. So the investors are investing using Bitcoin, and there's no sort of performance fee unless you get, more Bitcoin out than you put in. And it's certainly a factor for sort of so-called crypto hedge funds that people really hate paying a performance fee on the price appreciation of Bitcoin because they can achieve that sitting in a cold wallet, right? So what we're saying is, when you put money in, if the price of Bitcoin is 35,000, when you take it out, maybe it's 100, 200, we don't know, but we won't charge a performance fee for the change in the Bitcoin price, only for a change in the amount of Bitcoin, for an increase in the amount of Bitcoin paid out. And of course, there's also a management fee to cover overheads and, the bonded warehouse fees and things like that.
So in terms of the dynamics of mining in general, you referenced this a little bit, maybe in terms of why you might be getting some of these rigs at a discount. But my sort of high level understanding of mining is that there is more credit that was available to miners this last cycle than ever before. And there were a couple of big lenders, without naming any names, they'd be names that many people listening to this podcast probably know. And there was a situation I remember hearing about maybe 12 or so months, like about a year ago, something like that, where this was supposed to be a bad situation and some of the lenders were underwater and yada, yada. How did that whole situation end up resolving itself? How do you see the presence of credit changing the dynamics in just the pricing of ASICs in the mining market in general moving forward?
I view it as an indication of undercapitalization. So the Bitcoin industry, the mining industry particularly, is undercapitalized. And so, where a company like Dell or Tesla or Microsoft, Dell, Tesla, Apple, people making physical goods, they can get large amounts of capital to build an inventory from, debt markets. And Bitcoin historically has been viewed as too novel for those kind of debt providers to provide. And so that's turned to, so if they weren't able to raise capital from equity markets or normal debt markets, that there's still a need, right? They still need to build the inventory, they still need to get it online. And so they would just use some non-traditional methods. So they would, borrow at margin lending rates. So the Bitcoin ecosystem interest rates are double digit because of a phenomena of people trading on margin, like leverage trading Bitcoin or taking out Bitcoin secured loans for personal reasons. And that's the rate for that tends to be high because the capital is coming from other users basically. And so the market is like asking a user what interest rate they want to get paid before they will defer buying Bitcoin. And they'll get impatient and they'll buy Bitcoin, so their money will disappear, right? So it ends up being a high rate, 15, 20% quite often, and even higher in a bull market. So that rate is then been picked up and used by lenders. And like, what's the collateral available? Well, it's Bitcoin or it's ASICs. And now the danger with that is, margin trading Bitcoin is already volatile. So doing margin on top is risky. So, I think it definitely contributed to the volatility in the market. There would be liquidations of Bitcoin and public and private Bitcoin prop mining companies, like mining for themselves, not providing hosting to third parties, who would be selling Bitcoin in the market just to cover costs or to repay loans and things like that. So I think it exacerbated the downside in the market. But I think they also didn't really, didn't have enough capital to do nothing, right? They had to do something, or there wouldn't have been enough hash rate. But as a result, they overshot, and that was expensive and probably contributed to the down market for periods where some lenders would be liquidating, or just people selling more Bitcoin to cover operating costs in a down market.
So maybe to sum up this investment strategy from the basic standpoint is you're sort of observing this inefficiency in the market because there's a structure under capitalization for Bitcoin miners. You might expect this sort of under and overshoot in terms of getting rigs, like the price for rigs and demand for rigs to persist. And so you're allowing investors to earn a Bitcoin on Bitcoin return by basically buying rigs when they're low, denominated in Bitcoin, and then selling them again when they're high.
Yeah, that's right. And this fund is one shot, right? So it's not going to reinvest. It's going to buy the miners, warehouse them, sell them back, and then pay out the Bitcoin or wind down the fund. So it's not trying to time the market or do something short-term speculative. It's a kind of one-shot thing. And, hopefully that liquidity that it adds to the market will be useful to the people who are, struggling to sell miners when they need the liquidity as well, right? So it's, and the liquidity is, Bitcoin basis. So I think part of the problem for this whole ecosystem is that the people who own Bitcoin, like the individual Bitcoin investors, tend to end up being very all in. And so the prospect of buying, making an investment as Bitcoin correlated using dollars, they're like, well, I don't have any dollars. But the prospect of putting a an allocation, like bearing in mind any strategy has risks, into a fund that is paid using Bitcoin itself, that's something that people can more plausibly do. And so ultimately that indirectly helps companies with inventory, because it's a new buyer in this market, to help sort of temporarily absorb some of the excess.
One thing that I think has been relatively unique about this cycle, if you look at it, I could actually pull one up here in a second, but if you look at the chart of Bitcoin hash rate, it has just been absolutely up and to the right and leading Bitcoin price, which is my mental model for this was always that price moves first and then miners will sort of scramble to bring hash rate online and therefore hash rate sort of follows. But it feels like we've seen a deviation there. Do you have any thoughts on why that might be?
Yeah, it's related to this oversupply. So I completely agree. I mean, some people have some, to my mind, novel idea that the the price is set by the hash rate, but like you said, it's the other way around. The hash rate follows the price. But what's happened this time is that a lot of miners bought ASICs and weren't able to get them online very quickly. And so, after they've already bought them, they're in a sunk cost situation. So, they might be suffering regret and they wouldn't, choose to buy if they hadn't already bought. But given that they have, and as long as turning them on or finding somewhere to host them, makes a net return, like reduces their loss, they will do it. And so, that's how you came to see the hash rate continues to go up for most of the periods, even though the Bitcoin price was pretty low, the mining profitability was pretty low. It was just that there's a lot of sunk cost activity to clear out the inventory, right?
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later.
What do you think, Adam? Hash rate tends to get brought up around this topic of Bitcoin security. And this is where I want to transition maybe to a slightly more technical part of the discussion around Bitcoin block space, the security debate, et cetera. And, one question that I had for you is, I've gotten a lot of different answers on this, but how do you, for instance, when you view a chart like this of hash rate going online, is that one-to-one additional security for the network? And I guess something I've been trying to work out in my head, and frankly, I would love to get your thoughts on this as someone who I'm sure you've thought about this quite deeply, is, what is the introduction of new, more efficient ASICs that are able to produce more hash rate for less dollars in? Does that make the network more secure? Because the way that I'd always thought of it was really hash rate is a proxy that what it represents is the amount of collateral that you staked to the system in the form of the cost of the ASIC and the ongoing electricity costs and whatever other sort of like utilities or whatever you need to do to keep your mining rig online. And so on the one hand, I could see cheaper, more efficient ASICs, like it makes the hash rate go up. But on the other hand, you have now, sort of posted less collateral in a sense as well. So an attacker could, purchase more of these cheap, more efficient ASICs and do something like that. You know what I mean? I sort of have a hard time. My brain gets into a pretzel pretty quickly thinking like this. But how do you think about the relationship between hash rate and network security?
Yeah, I mean, I think there are two aspects to the cost structure. One is the capital investment, which is a commitment to the network security, because people will spend quite a lot on a miner, $10,000, $20,000 on an individual miner with, 100 terahash plus. And that miner, if Bitcoin were to fail, that miner would basically be worthless, right? So you are really, you have a kind of affinity to wanting Bitcoin to succeed and continue and be secure and reliable and dependable. And so there's that commitment. Plus, many miners are, Bitcoin bulls, right? They try to keep as many coins as they can because the price goes up. You saw that in many of the public mining companies. They're trying to increase the number of coins they have in inventory over time. So I think the Bitcoin holding, the ability to recover the capital investment, that's one part of it. And then the other part is, the operating cost, right? So that is also a part of the security budget. So in terms of the miners' sort of combined investment between the capital and the operating costs, they just have to, get back more dollars than they put in, and then they'll try to get an additional upside by keeping as many coins as they can. They may have to sell some to cover their power bills, right? So then in terms of the miner efficiency, I think, that's a reason why the hash rate can go up faster than the security budget. I mean, if the security budget is how much is being spent annually to secure the Bitcoin network between capital and electricity and so on, then the hash rate is actually going up a little faster because machines are getting faster every year. And so I think there are people who have started to refresh machines, like phase out less efficient ones or bring new ones online, and they are a bit more efficient. In a period where the profitability gets bad, also the less efficient miners will tend to switch off sooner, and many miners don't own the hosting, the infrastructure, right? So if they stop mining, then somebody else will come in with newer miners. So I think, a refresh to a new, more efficient miner at the moment is still a big commitment to the future because, even though profitability is improved, the price has gone up faster than the hash rate, right, this year. So the price has doubled, but the hash rate hasn't quite. So there's a bit of a profitability improvement, but it's still, not a super high margin time to make a fresh mining investment. So people who are, buying new, more efficient miners, put them online, they're taking a relatively long-term bet on, the profitability improving, which is going to be driven by the price, right? So I think, it's a kind of rolling, recurring cycle of investment and operating cost that is securing the network.
One of the dynamics that I sort of remember, being relatively consistent, but I'm wondering if the persistent availability of credit changes this for miners, is typically miner capitulation marks the bottom of these sorts of cycles. So, what you've seen in the past is, if we had to briefly describe the cycle, the price of Bitcoin goes up, miners chase that in terms of bringing mining capacity online, the hash rate goes up, the price turns over, miners try to make it for as long and as far as they can. And there's like a little bit of nuance there in terms of cloud mining models where people try to shut down their rigs and et cetera, et cetera. But then eventually there's this big capitulation, which is miner sales of Bitcoin, and that tends to mark the bottom. My question is, did that happen again this time? Were we able to stave some of that off because of the availability of credit, and maybe rigs just change hands into, they're repossessed by creditors? Or how do you see that dynamic still playing out into the future?
Yeah, I mean, I think the credit probably made it worse because
Interesting.
it created some liquidation scenarios where the lender, had the borrower's Bitcoin as collateral to buy ASICs, or the ASICs themselves, right? And I think the credit has dried up significantly because there have been some major lender failures that are currently in bankruptcy or in disputes. And there are lenders who are, solvent, but have losses on their books and own ASICs. So they've become, they're either be looking to sell those or hold on to them for a better price, or they start mining, try to find someone to host the miners and try to recoup the loss by mining the ASICs that they ended up repossessing from the collateral. The credit available at the time allowed people to go risk on more.
That's really interesting. I thought, because you could see in maybe one sense it allow you to extend some credit. You don't need to sell the Bitcoins as well. If there are miners that are particularly disciplined, that then you can see that being a good thing. But you can see it going the other way as well. There's a lot of undisciplined new entrants that might not have that battle hardened, mini cycle sort of
yeah. I mean,
focus.
It probably worked for some people. You can see there's quite a variation in how the public mining companies, where you can look at their data, how well they fared through this, like how far their stock fell, how quickly it recovered, their debt ratio. There are a few that entered bankruptcy that look to be, able to, get back on track and get out of bankruptcy. Some of them that may not make it. But ultimately, it's all part of the economic cycle. So, all of the ASICs that were manufactured presumably will eventually get online because, somebody, whether it's the creditor or a new buyer, some people are buying on a secondary and then putting them online and having a lower cost of purchase.
Last question for you on this area of security would be, people have a lot of thoughts about sort of the long-term viability of the Bitcoin security model, which would be, to summarize for folks who might not be as in the weeds on this, is the Bitcoin obviously has the 21 million hard cap supply. There are two methods by which miners get compensated. One is a block reward, which is paid to miners that are able to mine a block, and that programmatically goes down. It's adjusted down by half every 4 years, which is the halving. And then there are transaction fees as well, whereby miners get paid by accepting sort of priority fees for various transactions. And the majority today of the way that miners get compensated is from the block subsidy, which is decreasing over time, and transactions might not have ramped as much as some folks would have liked. And the question is is the transaction fees alone going to be enough to pay for the miners and all their efforts in securing the network going forward? So long term, and how do you answer or think about that debate?
Yeah. I mean, what we've seen is that the fees tend to go up the most in a bull market, and that is basically traders. So the traders tend to be the most impatient, and they don't really, if they pay $10 a fee rather than 10 cents or $1, they don't care that much because, if they're doing a trade in the tens or hundreds of thousands, their trade commission will be, maybe 10 or 20 basis points, which is a lot more than the transaction fees. So they would sooner pay more and get their transaction, their coins moved between exchanges. So they tend to push the fees up. But I think the other thing when people talk about this, I think it's actually, we've got a lot more time to see how it develops than people may be thinking, because people are always looking in the moment, right? But the historic fact is that Bitcoin has doubled every year for a decade, right? And so they'll think, oh no, there's a halving, the number of coins is halved. Yeah, okay, but it also went up 16 times in the same period, right? So effectively, the mining reward, or the amount of revenue going into mining, is going up by a factor of 8 every 4 years, and has done for the last decade, and probably will for the following decade. Mm-hmm. So, even if it tapered off, so it wasn't 8 times, it's still a very high multiple in security budget. So, if anything, the security budget is probably larger than it needs to be. So there's a lot of headroom. And, there seems to be quite a bit of headroom in terms of Bitcoin's potential adoption as an asset class. So I think it's not a short-term problem. And also, the fees have got, become a higher percentage over time. Now, some layer 2 things do sort of reduce fees. So people doing retail payments on Lightning took some of the pressure off the main chain. Of course, it still flows through to the main chain because they have to open channels and they'll be converting backwards and forwards. But, I think all the different layer twos effectively create more transaction capacity for different, specialized for different use cases. And it's a supply and demand thing, right? So if there's more supply, then it will sort of reduce the fee cost. But also, I think it's healthy because people who do trading on Liquid and micropayments and retail payments on Lightning, they free up space for people to do cold storage and sensor resistant transactions on the main chain to make space for more users to adopt Bitcoin for what it ultimately is best for. So I think it's also giving the capacity to expand a user base.
Yeah, I that's very well said. One thing that I wanted to, maybe we can end our conversation here and get in even a little bit more technical detail than we've discussed so far, just talk a little bit about Bitcoin block space is, the other solution that has been put forth, which I think has been a little bit controversial, is alternative uses for Bitcoin block space, which I know is a very long-standing debate. So that would be something around ordinals. And for those of you who are listening and are not familiar with ordinals would be, they're sort of a Bitcoin native form of NFTs, wherein unspent, I'm a little out of my zone here, but I think it's UTXO is arranged in a certain way, almost. You can inscribe a picture to them, and this was made possible by the recent Taproot upgrade. So there was kind of a little bit of a, depending on how you look at it, a new way to use the block space, or a little bit of a loophole in the upgrade, which allowed the proliferation of these ordinal NFTs on the Bitcoin blockchain. And I think that might have catalyzed sort of a renewed look at Bitcoin block space from the perspective of like the BitVM. Layer 2s have obviously been going on for a long time, drive chains, etc. And I guess just to start from a high level, Adam, which camp do you sort of fall in the look? Yeah, Bitcoin should really be used for financial transactions. That's what it's best at, and that's probably the right way to look at this. Or do you fall more in the camp of like, well, look, if the code says that it's a possible thing to do, then the code is ultimately what we should be going by here. And people want to use the block space for this. I'm not a huge fan of it, but I guess it is driving up transaction revenues.
Yeah, yeah. I mean, it's it certainly changed the narrative there a bit, so that the security concern, which people oscillate between the long-term sort of financial security budget. They're like, well, no problem. People are paying lots of money, hundreds of dollars to store a JPEG in a blockchain, right? And
right.
That's all very funny. And of course, the other ironic thing is, some people are annoyed by it, but like, you can't do anything about it because Bitcoin's censorship resistant. So, by definition, it's a free market thing, and people will do whatever they want to do. And I think the unfortunate thing is that each of the JPEGs are like 100 kilobytes or something, would displace hundreds of UTXO from being created that were financially relevant. And so, maybe that would price out some people in emerging markets from being able to cold store their Bitcoin, and they'd have to use a custodian or something in exchange, right? So, the block space is limited, and the free market, is great and all, but it does mean that the people that can spend the most, or can afford the fees, will do it. And so, if the Bitcoin blockchain is basically being too heavily used by, rich digital art collectors, that's possibly problematic for emerging market, cold storage and censorship resistant transactions, right? But I think the other factor that people hadn't seen coming is that Bitcoin is sort of adaptive based on, a combination of users, how they behave in the market, and the technology providers who build workarounds. And so, it actually made Bitcoin more scalable. and the fad passed a bit, as right. People got bored of it after a while. But one example of how this played out was there's a sort of trustless atomic swap. It's called a submarine swap between Bitcoin UTXO and Lightning capacity. So there's a company called Bolts. It's Bolts HQ on Twitter. And they have this kind of trustless swap, and the ordinals and the inscriptions basically broke the swap. It stopped working because the fees were too unpredictable and too expensive. And that's a problem, right? They can't do their main line of business. So they got busy, and within the space of a week or so, they'd implemented a swap between a liquid Bitcoin, so a different layer 2, and Lightning channel capacity. So you've got a main chain Lightning channel capacity, and you could add or remove Bitcoin from your channel capacity without doing an on-chain fee. And so, the inscriptions basically made economic conditions which forced that to happen. And the interesting thing is, even though the fees have dropped and the inscriptions have become less popular, the Bolts HQ liquid adoption remains, and it's like 60% of their trade volume now. So it's actually more than the on-chain swaps, because the people that adopted it sort of, they're like, well, it's cheaper and faster, so let's keep doing it, right? So while their overall metrics are growing, like, more people are using their product over time, the percentage that is happening on liquid remains higher than on the main chain swap now. So, that just shows that the market reacts to, it's not inelastic, basically, right? So if something happens that makes things inconvenient or costly, different startups and technologists will figure out a workaround, and whatever works best will get adopted. And then the network will be, a little bit higher capacity, a little bit more resilient, until the next thing causes another fee surge, right? And then presumably there'll be another reaction that will, add some more capacity.
Mm. All right, maybe in closing here, because you're referencing Lightning a little bit, and I know, Blockstream has been busy releasing all these new products, but you have a very interesting new solution called Greenlight. So could you just give listeners sort of a review of what the Lightning channel sort of is? Refresh us a little bit on how adoption is going over there, and your sort of vision for layer 2s on Bitcoin, and then maybe we can end just talking about Greenlight.
Start by saying that every Lightning transaction is actually still a Bitcoin transaction. It's just that it's constructed in a way that you can sort of just wait, you'll get a payment and you won't send it to the main chain. You'll just hold on to it, and it will get replaced when there's another payment. And so you have this pattern where there's one transaction on the chain which is set up the Lightning channel, and then there will be hundreds or thousands of small retail transactions paid via or routed through Lightning nodes. And so you get a kind of multiplier effect where you can do more kind of financial activity per actual on-chain transaction. And so, there are a few different models for doing that. Some of them are custodial. So I think the data point somebody put out in a research report was about 50% of the Lightning wallet by usage is actually custodial, but it's still a Lightning compatible transaction. And the others are non-custodial. And the non-custodial ones, there are a few different implementations of libraries and wallets that make that convenient, but ultimately they're doing quite a bit of clever work in the wallets and in the libraries to make that work, because it's a lot for a smartphone to do, basically, to sync with the gossip information, stay online to receive transactions, and keep up to date. In some cases, they have a full node, so they'll sync up to the chain again and keep this node operating on the phone. So what Greenlight does is it's a bit more like, so if you think about with the main chain, a lot of these wallets are a bit like a full node, but for Lightning, right? Like a full node wallet for like Bitcoin QT or something. But another way to use the main chain is the hardware wallet. And so the hardware wallet provides a very high security assurance, but doesn't know a lot about what's happening on the chain. it's not aware of, it doesn't receive a blockchain. You just send it a proposal. I want to pay this address, this much Bitcoin, and these are the UTXOs that you claim you own. And the hardware wallet will just enforce a few simple things. The amount you pay is what you think, and that the address that you expect to receive it is the one that receives it, and that the change goes back to yourself. But it doesn't actually know if you actually own that UTXO, or even if that UTXO exists, right? Because it doesn't have a view of the network. But it turns out to be secure to do that, because the network and the receiver will verify it and assure it. So Greenlight kind of has that hardware wallet-like model, but for Lightning. So it's, the integration into a smartphone application or in a wallet is very lightweight. It just, you give it instructions about how much you want to pay and who you want to pay. And there's a node, a Lightning node running on the cloud that will give you the information to sign and verify. And so the advantage is that it's much more lightweight. It doesn't have to receive as much data. It doesn't have to sync when you come back online. So it gives a kind of, efficient, lightweight experience, easier to write a software wallet. And there are some wallets that are integrating Greenlight as their way to interact with the Lightning Network. Breeze is one of them, and there are a few more in the works. And it's also potentially convenient for applications that are not themselves wallets that want to add the ability to pay with Lightning, like a Nostr application or a game or something, because integrating a full Lightning wallet as an embedded app inside a game is kind of heavy, right? Whereas calling the Greenlight APIs is much more lightweight and easy to do.
Awesome. I think that's probably a good place to end it here, Adam. And guys, I highly recommend that you go check out some of the things that we were talking about, basic Greenlight, if you're a Lightning user. Adam, I really appreciate you coming on here. What is the best way either to find out more information about Blockstream, basic, any of the stuff that we talked about, follow you, et cetera?
Yeah, for Blockstream in general, it's blockstream.com. And there is blockstream.finance has information about the financial products. The regulatory work is done by Stocker, so STOKR.io. It's a Luxembourg company. So they have information about the products as well.
Excellent. Adam, this has been a real pleasure. Thank you so much for coming on the show. We'll have to do it again soon.
All right. Thank you.
Cheers.